So within all of this, even with the risk-off moment we had around Iran, Karissa, we still didn't have bonds really take off the way gold did. But it's also the bond market's not giving it all back either, even with the stock market rallying. So what are we to make of this?
Well, it's really interesting. Again, you do have to step back and look at the macro side of it. I think a lot of it is that U.S. Treasury yields have been following European yields. And we have seen a bit of a move upwards in the German Bund. So I think the story in 2020 is going to be a bit of a convergence trade, where there still is such demand for U.S. Treasuries being the safe haven that it is, but they're going to walk in lockstep to a degree with European yields. And you've seen German Bunds and other yields moving upwards, bringing Treasury yields up with them. So that's something that we're looking for. Another thing that's happening is that the Fed and other central banks have really said that this is it for their accommodation. This is kind of peak accommodation, 2019, 2020. It looks like they really want to hand off, global economic growth responsibility to fiscal policy. So to the degree that whether it's the US or China or Europe really takes the reins and starts to make fiscal spending a priority, that's something else that we see. There could be additional volatility when people start to see those central banks start to back off. So that is something that we're watching as well.
This is why I think it's so interesting. We've got right now, according to Fed Funds Futures, Chris, a 60% chance or 57% chance of a cut in 2020. Even though all the signaling is exactly as you describe, does that mean those chances are going to have to get out of the market, which means yields moving back again higher with some gusto? Or are we always just going to have this, put or conception of a put or some myth of a punch bowl lying around? I don't get it.
Yeah, well, I think this is a tough year to really look for that. We always say that the Fed is independent, and I think they did a good job in terms of engineering a soft landing here. Some of the data was so weak back at the end of 2018, and they managed all those cuts through 2019 to end up in a place where we're not looking at imminent recession. But you're right. The Fed has been in this continued position of accommodation, or kind of the put, just like you said. They're looking for fiscal policy to occur. And I think during an election year, it's especially difficult for people to look to the Fed or really any other central bank to make a real stand and start to hike or remove an accommodation when it's not clear what policy is going to end up being on the other side. And we also have said, even if this U.S.-China deal is signed, that even may not lead to, say, inflationary pressures, because real economic damage has actually been done by the trade war. So the Fed is kind of in a pickle. It's got to stay where it is. I think 2020 is not the place to start looking for removal, as much as they say the words that they would like to start to step away from being the put for the market. One
of the things I hear still, with all this being said, is that there is a fairly obvious kind of limit on the degree the 10-year can move. I don't really see a whole lot of projections of anything past, 2.2% is like the highest one I can find, by year end. I'm kind of generalizing here, but the idea is nobody really thinks it can move quickly to the upside. Chris, is that a mistake?
Oh, no, that's correct. Like I said, the 10-year yield is really going to be in a channel here. The two things that drive interest rates, especially longer-term interest rates, are expectations of growth and inflation expectations. And to this point, neither of those look like they're going to break out to the upside. This issue with Iran more recently may have allowed some degree of speculation about inflation, and maybe it allowed some of these weaker energy companies to refinance with higher energy prices. But I think longer term, it is not truly an inflationary event. And so seeing neither of those two things, global growth, global inflation picking up, we don't really expect that 10-year yields are going to move up in a substantial way. We do think possibly the 10-year is going to be over 2% by the end of the year, but I don't think that's a really bold call at this point.
Okay. Tomorrow we'll get some CPIs. We'll get a little update here. And to your point, not much from the wages side on Friday to suggest, trickling down through inflation in a big way. There's also the repo action from the Fed. They consistently say that it's nothing to see here, and it's not QE and all that stuff. But even before the Iran situation, bonds were getting a little bit of a bid again in December. Gold was doing the same. It seems like there's a big portion of this community that thinks otherwise, Karissa. Where do you guys fall on that?
Oh, in terms of, the Fed does not want to be providing QE. They don't want to call it QE. I think a lot of market participants want there to be a standing repo facility. I think the big lesson that you take as a bond investor, whether you're talking about repo specifically or you're talking about, risk assets where liquidity is extremely important. Liquidity is good, funds flows are good until they're not, and it can reverse very quickly. And the Fed realizes this. We're also surprised that they haven't announced some sort of standing facility to support those markets, because every time that treasuries or cash were in great demand, you saw those repo rates just move up pretty substantially, and that's not helpful to the functioning of the banking system. So I think the Fed is, again, they're going to have to come out and do something to support this market as well if they want liquidity to be healthy in this market.
On a shorter term basis, I'm curious what you think about the relationship between stocks and bonds. For a long time, given that the Fed was in the market, it made sense for bonds and stocks to go up together. Bond buyers buy the bonds, stocks enjoy the multiple expansion from the bonds, and the yields being low. But Karissa, if the Fed's not going to be as active and now stocks are like in full-on melt-up mode right now, how long does this continue before bonds start to respond? Are stocks just so AWOL that bond investors don't need to worry about whatever they're signaling about the economy? And how are the two going to fit together?
That's been a mystery to us as well. I think what we're seeing is, valuations are really stretched across the capital structure. Whether you're talking about equities, you were just showing those charts in the NASDAQ. It was just unbelievable moves, momentum-driven moves. Again, there is a vast amount of liquidity in the equity markets, and to a lesser degree in risk assets and fixed income as well. This relationship cannot continue indefinitely, however. Like I said, the Fed is not going to be the buyer of last resort forever. Maybe 2020 is not the time to test that. But at some point, the historical relationship is going to be restored. And I think the form that will take is risk assets could suffer. And that's always the view that you have to take in fixed income in particular. I know equity investors may not like to hear it, but fixed income, you really just want to take your bets, be careful, be strategic, and manage risk. And so that's always what we're looking to do. You buy kind of the best, safest yield that you can. Again, I don't know to what degree the excess liquidity across capital markets is impacting this relationship, but this is not something that's going to persist forever. So I'm in agreement with you. Something is going to give.